It's again an extremely tense and stressful Monday morning with unideal headlines on the wire. So oil starts the week near the $100 per barrel level following the bombing of Iran's key export hub on Friday. Now, while we see some relief in Asia on news that two tankers were actually able to sail through the Strait of Hormuz toward Asia, while the risk of further disruption in the region remains high. For markets, the key question now is how central banks will respond to the new energy shock, and we will have the answer this week, which is packed with central bank meetings around the world. So welcome to Swissquote's Daily Market Talk. It's Monday, the 16th of March. I'm İpek Özkardeşkaya, and we will talk about a lot of things today again. But before we do, and as always, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So the week started on our usual pattern with oil prices pushing higher at the weekly opening bell and retracing part of the early gains as investors around the world digest the latest news from the Middle East and their implications for the global economies. Now the major ones of late are the bombing of the major Iranian export hub late Friday. Yes, it always happens during the weekend. The Iranian announcement that the Strait of Hormuz could now be used by the ships of countries that are not the US, Israel and their allies. We'll figure how they will define allies and how they will check if they are the ones that are sailing in the ships. And the announcement from the IEA that the oil reserves, the 400 million barrels that they're ready to release from the strategic reserves, will be made available immediately in Asia, which is the most dependent region on oil that comes from this very Strait of Hormuz. So overall, if we sum it up, the bombing of Karg Island late Friday and the continued attacks in the Middle East points that the war there is not looking near an end. But the good news is that there is some relief this morning in Asia on news that two tankers carrying liquid petroleum gas to India could actually sail through the Strait of Hormuz. Then there is a political dimension to the question as US asks countries around the world to send ships to the region to help sailing go on, to help them, whatever help the US is looking for in a war that it decided to start on its own with Israel and didn't consult other NATO countries means. And while the reaction is mixed from the European allies, it's indeed very politically and geopolitically sensitive call to be made. The Europeans are meeting today and the latter will decide whether they should or not help the US. And I'm very happy I don't need to comment on that. So what I will do here is to take the geopolitical headlines as a given, talk about the impacts on oil prices, and comment on the potential global economic implications of the latter. So, US crude kicked off the week with a spike above the $100 per barrel level and is consolidating gains near the $98.5 per barrel level at the time I'm talking here, while Brent crude began a touch below the $100 per barrel level and is now trading a touch above this mark, while the Dubai crude is diverging very unusually from the rest, with the barrel trading past the $103 per barrel level there this morning. The relief that oil will maybe gently flow toward Asia pushed many regional indices higher. The Nikkei is up by nearly 1% at the time I'm talking here this morning. The Korean Kospi index rebounds more than 1% as well, while the Chinese CSI 300 index first dipped at the open, but the index actually managed to retrace its earlier losses on economic data, showing better than expected investment, production, and retail sales data, while the uptick that we saw in the unemployment rate kind of worried investors. And now that we are speaking of data, well, Friday's US data came in with surprises and not necessarily good ones. The US GDP was revised further down to 0.7% for the fourth quarter, down from 1.4% printed a month earlier and way below the 4.4% printed for the third quarter. Sales there grew just 0.4%, while price pressures increased to 3.8%. That was in the fourth quarter of last year. The more recent data show that the core PCE index in the US, which is the Fed's favorite gauge of inflation actually ticked higher to 3.1% level in January from 3% printed a month earlier. That uptick was broadly expected and it was also broadly priced in, yet the confirmation that the price pressures in the US were rising even before the Middle East war pushed energy prices higher in the US didn't necessarily enchant the Federal Reserve doves. And the Fed will meet this week and will probably leave the interest rates unchanged. Pressures from the White House and the president himself will not change a thing, mind you. Even less so as Donald Trump's latest attack on Jerome Powell, remember, on the headquarter renovation was judged by the US court thin and unsubstantiated. So in summary, there will be no rate cuts this week in the US and maybe no rate cuts this year either. I will repeat that again. If the war in the Middle East continues and continues to pressure the energy prices higher, there will be no rate cut in the US this year and politicians, not Jerome Powell, will be to blame. So the US 2-year yield is now at the highest level since last August, while the US dollar index spiked to the highest level since November. The greenback is softer in Asia this morning, which is also giving some support to the regional indices, but the conflict in the Middle East is not over yet, and the US dollar's appreciation may continue in the coming weeks, along with rising global energy prices that demands more US dollars to be bought and waning dovish Fed expectations. Now, the Fed is not the only central bank to deliver its decision this week. The week is indeed packed with major central bank decisions, including the European Central Bank, the Bank of England, the Swiss National Bank, the Bank of Japan, the Reserve Bank of Australia, and the People's Bank of China. All of these central banks, among others, will all announce their latest monetary policy verdicts this week, and their job is not easy at all. All of them will be torn between the upcoming spike in inflation levels due to the rising oil and gas prices, due to the Middle East war, and the threat of slowing global economies and rising unemployment. Take the ECB, for example. The ECB was expected to stay pat on its interest rates for this year just 2 weeks ago, but the bank is now seen hiking the interest rates to avoid making the same mistake, say officials, than during the energy crisis that was triggered by the Ukrainian invasion. And that's not necessarily positive for the euro because it will tame the growth expectations there. The Bank of England, on the other hand, was expected to cut the rates this year, remember, 2 weeks ago, on confidence that inflation in the UK was poised to ease to the bank's 2% policy target later this year, and that the letter would allow the Bank of England to cut the interest rates to give support to the economy. And boy, the British economy really needs help. The recent growth data from the UK last Friday show that the UK's economy didn't grow at all in the month of January. 0% growth. Unfortunately, the UK won't get the help it needs from the Bank of England that will first have to deal with the upcoming inflationary pressures due to the rising energy bills before helping the rest of the economy. So no rate cut there either, and maybe rate hikes later this year. We will see what the MPC members think. The SNB, on the other hand, is expected to keep the interest rates unchanged this week in Switzerland. The strong franc could counter the impact of rising oil and gas prices on inflation and eventually let the Swiss National Bank sail steadily for a while the Bank of Japan in Japan will be dealing with the rising energy prices and the notable depreciation of the Japanese yen, which will likely pressure inflation higher and will keep the Bank of Japan on path for more rate normalization. The RBA, on the other hand, in Australia is expected to just announce a 25 basis point hike on Tuesday to deal with the inflation threat because they really don't want inflation to spike there on the recent rise in energy prices. So overall, if we summarize in one sentence, the central banks around the world will deliver hawkish statements this week, and the latter could weigh on sentiment if Middle East tensions don't de-escalate. Happily for those who are craving for other things to talk about, Nvidia's GTC conference that will take place between today and Thursday could eventually shift the spotlight back to the AI as Nvidia and its CEO Jensen Huang is expected to unveil the latest chip roadmap, and announcements often ripple through the broader technology sector and move semiconductor stocks. So let's see if they can find a spot in the war-crowded headlines this week. This is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.